for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, thanks for being here today. And I hear your argument that the FHFA's recent changes to loan level price adjustments does not punish borrowers with higher credit scores and down payments and won't impact them. But I have to drill down a little bit on your argument that this doesn't undermine risk-based pricing. Did the LLPAs assessed on any loans increase under the new pricing grid?
Yes.
In terms of credit scores, were there any price increases assessed on any loan with a credit score of 679 or lower?
I don't have the chart in front of me.
I think the answer is no. But the next question is really more revealing. Is it correct to say that all increases in the LLPAs under the new grid were assessed on loans with credit scores of 680 or higher?
I think the capital requirements for those loans, which the pricing grid is tied to, I think would reflect the risk distribution of those.
Yeah, the answer is yes.
Okay.
So every one of these higher fees goes to borrowers with credit scores higher than 680. And this is the problem that members have because our constituents have a problem with this. And it may advance a political agenda of equitable housing, but it doesn't advance the statutory mandate that you, as the FHFA director, have to promote safety and soundness. So what we think you're doing here by assessing higher fees on higher credit borrowers is you're actually contradicting the statutory mandate to advance safety and soundness, and you're putting taxpayers at risk. I want you to kind of take that feedback, evaluate it, and recognize that, yeah, in fact, the borrowers with the highest credit scores are the ones getting the higher fees. Let me follow up Representative Cleaver's very good questions about the Federal Home Loan Bank system. One of the key lessons from the recent bank failures is how quickly deposit outflows can cripple a financial institution. And Federal Home Loan Banks do have an ability to respond most instantly to their members' funding needs. This is particularly important for community banks and credit unions who otherwise don't have access to the capital markets. I hear what you're saying, that Federal Home Loan Banks are not the lender of last resort, but considering this recent history, would you agree that any suggestion to limit access to Federal Home Loan Bank liquidity could have negative consequences for financial institutions and consumers if residential mortgage assets can't be effectively liquefied or pledged through FHLB borrowing?
So I think first I'd like to say that even with these reduced fees, borrowers with high credit scores and high down payments will always pay less than borrowers with low credit scores and low down payments. That's FHFA's requirement, and we do believe that it's safe and sound. With regard to the Federal Home Loan Banks, the Federal Home Loan Banks have to issue debt. So when a member comes in, if they have a large requirement, the debt markets are not open 24 hours a day. And so what typically happens for the Federal Home Loan Banks is the members come in and they have staggered requests. And if they have a large request, then the Home Loan Bank has to plan for it because they have to issue debt to meet the funding requirement. And so we just think that planning, which is appropriate for the Home Loan Banks, which are the second.
Thanks for your feedback. Just remember the important liquidity provisions that Federal Home Loan Banks can provide here. On credit risk transfer, the SEC's proposed conflict of interest rulemaking exempts the GSEs as long as they're in conservatorship, but whether or not the enterprises are in conservatorship really should have no bearing on whether the transactions impacted create a material conflict of interest with investors. I appreciate that you've restored capital credit for CRT and revisions you made to the Enterprise Regulatory Capital Framework, which supports ongoing issuance of credit risk transfer transactions that protect taxpayers. But is there any reason you can think of why the SEC should not simply write a rule that can apply to all issuers of CRT or similar risk mitigating instruments rather than relying on these clumsy exemptions that undermine efforts at housing finance reform?
So I think that FHFA, so we have no jurisdiction on what the SEC should or should not do. To the extent they issue a rule, we have a responsibility to respond on how it impacts our regulated entities, and that's what we've done.
I'm just making the point. I appreciate it, and I yield back.
Someone's time has expired.